Let's do a general market overview. We can see that breadth continues to improve in the market indexes. The percentage of stocks in stage 2 in the Dow Jones is almost up to 47%, and in the S&P 500 we're above 30% now. But on the negative side, the Nasdaq is still trailing the S&P 500 and Dow with only 21% of stocks in stage 2, and that's a bad sign for a general bull market. You'll see the Nasdaq should have as many or more stocks in stage 2 than the S&P 500 and Dow, because the Nasdaq contains more high growth potential stocks compared to larger cap, more value oriented and non growth companies in the Dow and the S&P 500. We can look at the major indexes, and they're all still in stage 4. So even though we've had this big bounce, we're still in stage 4 in all the indexes, and we're still not seeing a large number of stocks pop into the watch list besides precious metal stocks. So that's another sign that even though we're undergoing a big bear market rally right now, we aren't in a new bull market quite yet. Now, what's been going on in this bear market rally is essentially like nothing is making new lows right now. You can see that new lows in the S&P 500 have fallen down to about 0. So there's really no this bear market rally is taking everything with it, including the most crushed and beaten down stocks. And there was plenty of stocks that got absolutely obliterated during the January and February plunge. You can see that the S&P 500 made 170 new lows in January and 90 new lows in February. So that's a lot of carnage in the S&P 500, and what we're seeing recently is mostly just a recovery rally since all that. And another thing that's interesting is that the S&P 500 equal weight ETF has actually gone back to the January gap where it initially broke down to start the year, and the S&P 500 itself is actually trailing this index right now. So, which means that the broader market as a whole has rallied, and that's exactly what I was just talking about. Like the pretty much every stock in the S&P 500 has been going up over the last few weeks, which the precursor to this bear market was the fact that only a few stocks in the S&P 500 were actually carrying the entire index higher, which is why it topped out here and then made a lower low here. But on this rebound rally, pretty much everything has gone up, which is why this equal weight index has actually outperformed recently. And you can see that down here. It's actually outperforming the S&P 500 compared to how the bear market started. So another sign that pretty much everything that's been clobbered has rallied um, in the last few weeks. Now, seasonally, this is one of the strongest periods of the year for the stock market, which is another reason why the January and February plunge was, probably a good counter trend buying opportunity, is because this period right now and then the period from October until the end of the year are the two times of the year that the market really tends to rally. We can see that again in this graph, which shows the returns of the last 40 years, and you can see that March and April have big gains compared to the rest of the months. Then you trail off in the summer and then have that end of the year rally. Now, one of the things I've shown in the past is the good shorting opportunities occur when the S&P 500 percentage of stocks above the 50-day moving average gets above 75%, and we just got above that last week. We got all the way to just under 85%, and today on the pullback we are down to about 74%. So we're right in the zone now where good shorting opportunities occur if this is still a bear market, but this can continue for a few weeks, so I wouldn't be surprised to see this hover above here for a while, considering that seasonally we can still get more of a rally. This chart shows kind of a separation between bull and bear markets, and this goes along with my stage analysis screener, but you typically want to see 50 to 60% of stocks in stage 2 for a sustainable bull market, or if you want to go back to the 200-day moving average, which would be like the 40-week moving average instead of the 30-week, which would be the 150-day moving average. But the 40-week moving average, you can see that back in the 2007 to 2009 bear market, once we broke below 60%, which occurred like right around that 2007 topping area, we never got back above 60% during the entire bear market, as all the stocks that were going down below their 200-day moving average weighed down the entire index, and we got a big bear market. Now, once that broke above 60% and the new bull market launched, it generally stays above 60% unless you get deep pullbacks in the bull market, which we saw in 2010, again in 2011, and then some minor pullbacks. Didn't get any pullbacks below 60% in 2013. We saw one in 2014, but then once we broke below this level again in mid 2015, which was right around here, we were back in a bear market. We haven't gotten above 60% of stocks in the S&P 500 above the 200-day moving average since the middle of 2015. So again, this is showing that the overall market is still in a bear market. And if we get it back above 60%, we have to start switching our mindset that the bear market could be over, and we should start looking for new stage 2 breakout opportunities. And we'll see the same thing in my stage analysis screener. Now, looking at the S&P 500 again, the equal weight index has been outperforming the regular index. So I think this gap right here is pretty important. Let's see what happens as we approach it, if we can fill it or not, and what happens after that. And we could actually even see a new high in the S&P 500, even though this could still be a bear market, which would be an odd thing to see for a lot of people, but it would definitely sucker in a lot of bulls that would be all of a sudden, rapidly bullish on the market, even though we're only about 5% from a new high in the S&P 500. So really a new high here wouldn't really mean anything important, because we still could move back into a bear, continue the bear downtrend, but it definitely would be a move that would get a lot of people fooled if it still was a bear market. And again, we would just want to see the character of the bull market, or the market overall, if it did get to here, whether we're seeing some high quality growth stocks breaking out, or whether it's just a big bear market rally that's ultimately going to be a failed rally that plunges us back into a bear market. And one thing as well that would trick people is that almost every single market sector will not make a new high, even if the S&P 500 does. So for example, the financials, which are a critical sector for the overall market health, they've got much more ground to cover. They got to go up more than 10% to get up to a new high, versus the S&P 500. And you can see that the gap in January is a lot further to go than it is for the S&P 500. Same thing with the former growth sector. The biotech stocks have just been acting horribly. They're bear flagging actually right here, even though that the rest of the market has pretty much rallied back up to its 30-week moving average. So this sector is horribly underperforming, which is a bad sign because another sector needs to take over as a leadership sector for the market to continue an uptrend. The Russell 2000, even though it's rallied back to the 30-week moving average, is still underperforming the S&P 500, and we'll want to see that reverse if the market were to turn back bullish. Plus, the Russell has a lot of overhead resistance now that was established back in late 2015, as the Russell was one of the first indexes to start collapsing. So this is going to be a good tell to see if it can get up to this gap. If it can, if it hovers here and has trouble fighting this resistance, then even if the S&P 500 is stronger, it's going to be a good sign that this is still a failed bear rally. And one other thing is going back to the stage analysis screener. On the markets page, it's very notable that if you look at the where things are at as in relation to the 30-week moving average, the consumer discretionary XLY, healthcare XLV, and financials XLF are all the furthest away from the 30-week moving average, which means that they are all, they're all below or the 30-week moving average, and they are the lagging sectors in the market, and they are typically the growth sectors. Same thing with energy and technology, XLK and XLE, and the defensive sectors, XLU, XLP, and IYZ are the ones that are the furthest above the 30-week moving average. So still seeing a lot of a defensive posture in this market because the things that are outperforming are still the defensive sectors, and that needs to switch around for the market to move back into a bull market.